One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
My name is Neeraj, and I'm a chartered accountant based out of Hyderabad. I have work experience in Deloitte and Grant Thornton for more than 7 years. After quitting my job, I started my financial advisory practice, and now we run a partnership firm called Holistic Prime Wealth. We are two partners based out of Hyderabad and Delhi, and we are primarily engaged in the advisory and distribution of all financial products. The taxation system in India is very straightforward now compared to the previous era that we have had. We have two types of taxation system in India. One is a direct tax, and other is the indirect tax system. So, direct tax basically means that any taxes that you pay out of your income. So, if you are a salaried person, the TDS deduction that happens is a direct tax payment. However, indirect tax system is a system wherein you pay taxes indirectly on your expenses. You may have different sources of income, right? You could have a salary income, you could have rental income, you could have interest income, you could have dividend income, you could have income from profits on sale of real estate or stocks. All of these are taxable. So every aspect of income is taxable. However, the method in which it is taxed and the rate at which it is taxed is different. And at the end of the year, when you have to provide the details of your income from various sources to the income tax authorities, all the income from different sources is clubbed, and then your final tax output is determined. So it may happen that even though you have a salary of less than 2,50,000 rupees, however, if you have a similar or more interest income, then you may have to pay some taxes. Tax planning should be a core component of your financial planning, because if you are able to plan your taxes effectively, you can save a lot of taxes, and that money can be used towards your financial goals, be it short term or long term. In the old regime, there were multiple ways to save your taxes. You could buy a health insurance, on which you could get a deduction of up to 25,000 rupees in a year. If you bought health insurance for your parents, that was also available for tax deduction. Then you could plan your investments in a way that you could align your long-term financial planning by also using the effective tax saving instruments. Tax planning effectively is very important because it can save significant amount of taxes, especially for those in higher tax brackets. The most popular tax saving strategy in the past has been either to buy an insurance policy from the most popular names like LIC of India, or go and do a fixed deposit in a bank, or invest in public provident fund. However, we need to understand that popularity is not enough to plan taxes effectively. We also need to understand that the instrument in which we are investing our money should help us not should help us in a way to save taxes today and save taxes in the future as well. Let us now take a few examples and understand which are the good financial products in which you can save taxes. So public provident fund, we have already discussed. We have discussed employees provident fund. There is something called equity linked savings scheme. So in this, what happens is you have to invest in an equity mutual fund, which is specially designed for such tax saving, and up to 1,50,000 rupees in a year within Section 80C, you will get that tax deduction. The difference between an equity linked savings scheme and a public provident fund is that the equity linked savings scheme has a lock-in of 3 years and is investing in equity. However, public provident fund has a lock-in of 15 years. So the selection of instrument will completely depend on your financial goals and your risk appetite. Apart from the investment products, there are products like term insurance, which gives you a tax reduction, health insurance, which we have discussed, which gives you a tax reduction under Section 80D. You can invest in national pension scheme. So there are three types of contributions that is allowed as a deduction in national pension scheme. So an employer can make up to 10% of your basic salary as a contribution to national pension scheme. National pension scheme has been designed and started by the government of India to replace the old pension scheme. So in this, the contribution made by your employer up to 10% of your basic salary again is not considered as a part of your overall annual income and is exempted for taxes. Similarly, there is another provision to contribute up to 50,000 rupees in a year from your own pocket to national pension scheme, which will also give you the deduction. This deduction of 50,000 rupees in a year is only available in the old regime. The contribution of 10% of basic salary through your employer is also available in the new regime and in the old regime. Further, if you are in the old regime and you don't want to utilize any other modes of investment like public provident fund or employees provident fund, up to 1,50,000 rupees in a year is also considered as a deduction in Section 80C of the Income Tax Act. Tax planning definitely will save you a lot of taxes, but it will also mean that you end up with less money in your hand on from your monthly income. So firstly, it is very important to understand that you must have a balance between your tax saving and the money that you need for your financial goals. So it becomes very important to first understand what are your financial goals. You must segregate your financial goals between long-term financial goals and short-term financial goals. In case there is a good amount of requirement for short-term financial goals, then there could be a possibility that you may have to compromise on tax planning and pay some taxes so that money is available in your hand to meet your short-term financial goals. However, in case there are no major short-term financial goals and you are comfortable in investing for your long-term financial goals, then tax planning can help you save your taxes in a lot of ways. So let us first talk about the different options available within Section 80C. 80C is as a wide canvas, and there are lots of options available to make investments in 80C. Now, which product is good under Section 80C to make an investment depends on the horizon of your investment. Okay, so firstly, you need to assess your risk appetite as well. If you don't want to take too much risk and want fixed returns annually, then you can consider investing in employees provident fund and in public provident fund, which give you fixed returns every year. However, if your risk appetite is a little bit high and you want to generate more than the fixed returns provided by employees provident fund and public provident fund, you can consider investment instruments like national pension scheme, which has an option of investing up to 75% of the contribution in equity, or you can consider equity linked savings schemes, which or invest 100% in equity. There are 2 to 3 tax exemptions that is easily available for a normal salaried investor. So firstly, if you are staying in a rented house, you get a tax exemption called house rent allowance. This allowance is available to you every year based on the rental payments you make and the city in which you live in. Then there is a standard deduction that is available to everyone of up to 50,000 rupees in a year. This will get factored automatically while your employer is calculating your annual tax liability and also at the time of filing the returns. There are two types of capital gains taxes in India. One is a short-term capital gain, and second is a long-term capital gain. First, let us understand what is a capital gain. Capital gain means any profit that you make on an investment. So, capital gains taxation is different for different type of investment instruments. There are a couple of exemptions and deductions available for long-term capital gains. Let us take an example of long-term capital gain on the sale of real estate. So if you have sold a real estate and made a long-term capital gain of 10 lakh rupees, you have a few options wherein you can save your taxes on these capital gains. So on a capital gain of 10 lakh rupees, your tax cost is going to be 20%, which is 2 lakh rupees. So if you so there are a few options which are available. Number one option is investing in Section 54 EC bonds. These are bonds issued by Government of India entities. Then there is another way of saving the capital gains on the sale of real estate, which is by investing the capital gain in another real estate. So if you happen to buy another real estate within the specified timelines, then you can save the capital gains taxes on that as well. If you are running a business, there could be two types of business. First business could be wherein you are engaged in manufacturing or sale of goods, purchase and sale of goods, or the second business or profession could be wherein you are in the business of providing services, right? So the good thing about businesses running a business in India is that you can charge all your business related expenses to the income. Business related expenses can use all expenses as a deduction to which are meant for their business. However, when you are buying an asset, then it cannot be completely charged as an expense to your business. You will need to charge depreciation over the life of the asset. So you have to be mindful about which expenses you are charging towards your business. You cannot charge your personal expense towards your business because that is not allowed under the Income Tax Act. Goods and services tax is an indirect tax system in India. Goods and services tax basically mean that you have to pay taxes on the goods you purchase or the services that you take. Goods and services tax rates, or the GST rates, which we usually call, is defined for each type of goods and service. There are a few goods and services which are also exempted from such taxation as well. So you need to understand which goods and services are taxable, which are not taxable. If it's taxable, then what is the rate of such taxation? So this is how goods and services tax works in India. For individuals who are generally salaried, the taxation changes do not happen frequently. You need to watch the annual budget that is released in the month of February every year to figure out what are the taxation changes that may impact you. So the recent taxation changes over the last couple of years are largely towards the introduction of the new tax regime, in which they have made everything very simple for the purpose of tax filing for both the person who is paying the taxes and for the tax regulator as well. As far as GST is concerned, which is the goods and services tax, the regulation and the tax rates keep, even though they are primarily discussed in the budget, but changes keep coming even throughout the year as well. So you could be mindful if there are places where you are spending a lot of money on an annual basis to see if the tax rates have changed for that as well. However, otherwise, as far as an individual is concerned, if you can track the annual budget and see the changes, there is not much to do beyond that for you. There are lots of places where you can update yourself with tax related developments in India. There are websites like cleartax.in, which updates regularly all the types of tax exemptions available in India. Even the tax changes that keep on happening are almost updated on a real-time basis on such websites. Then there are lots of good social media handles which keep you posted and updated for for any tax changes that happen. If you want to look at it yourself, then you can always visit the website of direct tax, of the income tax, and of goods and services tax, to figure out the recent amendments that may happen, because every amendment will be followed by a circular, and you can read the circular and keep yourself updated. So One Finance is doing a great job in educating people about personal finance, and also help them prepare their financial plans. So like we've discussed today, effective tax planning is a core and very important part of your overall financial planning. And One Finance is probably a very good shop for you to figure out how can you can save taxes by providing equal weight to your long term and short term financial goals, having a balance between them, and figuring out the best options available for you to save taxes at the least cost possible, and also in the most tax efficient manner. Because if you're investing only to save today, that is not enough. You also need to look at taxation, which will impact you in the future.
One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.